Joining us for further analysis on what's playing itself out in that market scene is Jacobus Brink from the Schmidt Family Office. Jacobus, always a pleasure and a good afternoon to you.
Good afternoon. Thanks for having me. Always a pleasure to chat.
All right, Jacobus, I think what jumps out the most for me at this point is the rand breaching that psychological 19 rand to the dollar barrier. What's happened there over the weekend that has us here in midday trade?
Yeah, no, I must say it was quite interesting to see the rand this morning above that 19 rand level. We've been stuck in a fairly sort of well-defined range over the last couple of weeks. You know, we typically traded down to about 18.25, and sort of hit the highs there around 18.80-ish. But I think this morning we did definitely see some dollar strength post the surprisingly strong payroll numbers that we saw on Friday. And I think if you just look at, we can unpack it a little bit now, but if you just look at, what the markets in the US are currently pricing in, there's a very big difference in what markets are pricing in from a Fed rate hike point of view since a week ago. So we also saw the MOVE index, which basically tracks the volatility of bond yields in the US, spike considerably higher. If you take it as a ratio to the volatility index of stocks, it's currently at lifetime highs. So there's definitely a lot of sort of uncertainty in the fixed income market around what we will hear from the Fed out on Wednesday. And I think that to a large extent is just driving sort of a little bit of a risk-off sentiment in general. We also, I think, another one that could possibly be influencing it is some more bad China news. I think by now we should probably be used to bad news out of China, but we saw some data out over the weekend, and the CPI consumer price numbers actually was falling at the fastest pace in 3 years. And while we're also seeing producer prices contracting, these readings certainly are still a concern for the Chinese economy.
I'm actually keen to get your thoughts on what those US markets are pricing in, Jacobus. I think a lot can change in a week. Literally a week ago, we thought the latest US Fed meeting would basically be a non-event. But of course, like you're saying, hotter than expected and non-farm payroll. What are market participants now contending with?
Yeah, I think it's a very difficult one. I think I've said this a million times on the show, but I don't want to be Jerome Powell at the moment. Definitely stuck in between a rock and a hard place. We saw clearly, that there were some clear sort of movements in the right direction when it comes to sort of, keeping the market sort of, thinking that we're probably going to stay higher for longer. But financial conditions in the US just eased up so much with this massive rally we saw in the stocks in November that we're actually now back to where we were from a financial conditions point of view, earlier in the year. And I think that definitely is something that Fed Chair Jerome Powell doesn't really want to see. So it's going to be very interesting how he sort of phrases the press conference on Wednesday. Obviously, they will have the benefit of having the latest inflation numbers. Markets expecting those to come out, fairly softish. But I still think, that it's definitely the rhetoric around Tim and Powell's speech is going to be the big thing to focus on. He doesn't want the market to get too excited too quickly. If you just look at what the market is pricing in last week, there were already a small probability, but some probability of rate cuts already, early in the year, January, March. But I don't think that's what they want to see. So you'll have to push back a little bit on the market somehow without upsetting the market. We don't want to have another sort of 2013 taper tantrum Ben Bernanke style, because that's going to derail a lot of things. But yeah, the big thing to me is, I think if the market starts pricing in an earlier rate cut, it'll be because they see some sort of problem on the horizon. Rate cuts maybe towards the end of the year, yes, probably. But if the market's needing rate cuts at the beginning of the year, they're clearly seeing some larger problems. And together with that, we've seen the unemployment numbers, even though they have come in stronger, the latest one. They do seem to be sort of moving, in the wrong, but in this case, the right direction to possibly give us a Fed pivot. So, it's going to be a very interesting day on Wednesday.
Well, we also have other central bank decisions this week, the Bank of England, the ECB. I'm keen to get what you're expecting to come out of there. We do know that this part of the world has actually had a very difficult 2023, but I'm wondering if they have turned a corner here with their inflation and interest rate picture.
Yeah, to some extent, I suppose they have. Still not expecting any cuts anytime soon there. I think a lot of the ECB speakers and the president of the Bank of England have actually been a little bit more direct in the way that they're trying to guide the market on this, because we've seen quite a lot of Fed speakers, some of them being much more dovish, some of them being hawkish, but no sort of uniform message you're getting from them. Whereas the ECB, I think, has been fairly consistent in all of their speakers in saying that we're going to have to leave rates higher for longer so we can ensure that inflation stays in check. We saw some inflation numbers out of Germany, etc. last week. It's sort of coming down, but it's still fairly elevated. It's still nowhere near the 2% level that they want. So, for me, the signaling that we've got, the guidance that we've got from the ECB as well as the BOE has been more consistent with, okay, let's keep it higher for longer before we make any sort of changes. So no changes expected on that front.
And then painting that picture coming out of China, which you mentioned there, that inflation print also coming out disappointing there. Jacobus, all year we've been speaking about stimulating the Chinese economy. It's the end of the year and we're still speaking about whether should the government be doing more to stimulate that economy. That economy clearly needs stimulus, Jacobus.
Yeah, no, definitely. And I think they've obviously been trying to signal those stimulus, but I think the big thing that hasn't really come through for me in there is consumer confidence. We're still seeing consumer spending. It picked up a little bit last month, but I mean it's still very weak, and just business activity in general is remaining weak. And that's obviously putting pressure on economic growth. And that's, as you mentioned, there's consistent headwinds that we've seen over the year. We have property market slowdown, export demand has been really low. So no, the Chinese authorities have obviously made some promises of more stimulus, but yes, at some stage, they will just have to take a really big step forward and then, get people sort of sentiment to just turn more positive in the economy. I mean, last month we saw some of the largest foreign direct outflows in a number of years out of China. So they'll need to do something to set up, just sort of to turn the sentiment around towards the country.
Of course, Jacobus, what's also interesting to get your thoughts on here is the inflation picture globally, a theme in 2024 again?
Well, I think it's probably going to stay a theme for a while. We haven't, despite the fact that we've seen very aggressive rate hikes from across the globe, most of the developed markets, emerging markets, a slightly different picture. It is still stubbornly high. I think what is quite interesting is if you overlay the 1970, when we had that big spike in inflation, if you overlay that data with the current sort of the way things have been playing out, it's very eerily similar. We saw this spike in inflation, and then inflation started coming down. But because central banks around the world were too quick to cut the interest rates, we saw inflation picking up again. And I think that's obviously a big thing that they'll want to they'll want to sort of nip in the bud. But yeah, so I think inflation will probably be a story for another few months at least, unless something breaks and we see some massive recessions all around, and that'll obviously have its own effect on the economy. But there are still a number of variables. The fighting in the Middle East, a lot can still come out of that. If Iran gets involved, if some of the straits that are some of the largest passages that oil gets exported through, if you see those getting closed, then oil prices can spike again. So yeah. Difficult one, and I think it's probably going to be topical for a while.
Well, that's not quite what I expected, Jacobus. I'm keen to get to the stock pick now, but before that, I'd like us to reflect on counters that have found favor with your industry peers.
I have to say it's Kumba iron ore on my side. I think more so with regards to the iron ore prices starting to climb nicely, and also the business is working very hard to cut their costs, and I think that that's going to work in its favor in the long term.
Alphabet, I love the company. It just came up with a new product this week called Gemini, which is the AI. And if you want to be amazed by what AI can do currently, just go look at the demos for AI or Gemini AI. And in fact, it's something available on Bard at the moment. It's the next step from GPT-4. And remember, GPT-4 only came out 9 months ago, so the progress has been amazing. And right now, I do think that Google has the lead in this sector, and we've seen the share price react positively on the news as well.
Keen to get your thoughts on those, Jacobus, Kumba iron ore as well as Alphabet.
Yeah, two ones at two different ends of the spectrum. Kumba iron ore, I think a lot of it's obviously going to ride. We've seen the iron ore price increase over the past number of weeks and months. I think, should we get this China catalyst, then there's going to be some more demand for iron ore. We'll see those prices go up. So a very interesting pick there. Google or Alphabet on the other side. I can't agree more. It's a great company. I suppose a little bit concerned about valuation. And, I think this whole AI boom that we've seen, AI is nothing new. It's quite impressive what the new stuff can do. But, I think the market has put quite a bit of a premium on that. And I think there's still going to be a lot of, cost future development. We'll have to see how this whole thing plays out and how it affects sort of society in general. But definitely longer term theme, yes. Short term, I think it might be a little bit overpriced. I mean, Google or Alphabet's trading at close to record highs again. If I had to pick one of those, I'd probably go with Kumba.
And which counter do you like?
I'm still a perennial China bull, and EM in general. So let's go for the China play.
Well, I absolutely agree with you there with Kumba. Let's talk about your stock pick. Which one do you like today?
So this is an interesting one. It plays into the whole theme of emerging markets. I mean, emerging markets have literally had probably about 15 years of underperformance versus its developed counterparts. So I think, at some stage that trade will probably start playing out. And my stock pick is MAS Real Estate. They invest and operate retail assets in Central and Eastern Europe. Most of it is sort of centered around Romania, Bulgaria, and Poland. They recently, despite some good numbers, they withheld its dividend to prioritize, paying down some of the debt because of the tighter funding conditions, which I think was a good thing from management. And operationally, the company's retail portfolios continue to perform great, and it's currently still trading on I think about a 12% forward earnings yield in euros. So yeah, interesting one there.
Well, but it's always a pleasure hearing from you. Thank you for your time this afternoon and also getting the week going for us. That was your midday markets update with Jacobus Brink from the Schmidt Family Office.